So today we're going to dive into what is actually happening in all of my portfolios here in Seeking Alpha, because I've got two companies that are at risk of either behaving badly, or I should say performing badly, or at risk of cutting its dividend. And so when I see those warning signs, it just makes me take a quick pause and think, okay, I probably should look at things a little bit further. So I figured I'd take you along the ride with me so we can dig in together. Now, if you have Seeking Alpha Premium, you can actually upload your portfolios so you can see everything all at once. I've got a total gain today of $713 to the tune of 1%, giving me a total portfolio value of $66,629. But what's super concerning to me right now are those big red warning stripes along the bottom of this screen. So for starters, let's dig in to see why Seeking Alpha is telling us that Home Depot might cut its dividend. So as you may know, Seeking Alpha actually uses what's called the quant rating system. It is proprietary to Seeking Alpha. Basically, it's an objective, unemotional evaluation of the stock, and it's based on data, things like the financial status, looking at their financial statements, price performance, analyst estimates, and the like. And the grades are relative to other companies being traded within the same sector. So that's important to know. So we've got a warning for Home Depot that it's at high risk of cutting their dividend. So let's look at this. Basically what they're saying here is that the dividend safety score is an F. And over the past 11 years, 64.4 stocks with an F rating did cut their dividend. Does it mean you should sell the stock? No, not necessarily, but that's why we're here, is to do an evaluation of the Home Depot stock to say, okay, am I still feeling good about having this company in my portfolio? So let's dig in a little bit further. So if we come over to the Home Depot specific page, we can see that today they're actually up 1.44% in share price. And if we look overall, in the last year, they're actually down 18.21% in share price. They've got a forward PE, it's under 20, it's at 18.88, and the dividend yield right now is 2.41%. But let's take a peek at the financials to get a little bit more information as to what's happening here with Home Depot. And looking at the income statement, we can take a peek at the total revenues. And you can see we've got some nice movement up and to the right where we're continuing to grow the revenue over time. And what we're looking at right here, this is the last 10 years of data. And you can see kind of looking left to right at the amounts here, they are moving in an upward direction, which is what we would like to see, growing revenues. Next, let's look at the basic earnings per share. And you can see that Home Depot has continued to increase their earnings per share year over year. And presently, we can see in the trailing 12 months, which is all the way over here, they have an earnings per share of $16.63. Now, why is that important? Well, I want to make sure that their earnings per share is enough to cover the dividends per share. You can see that Home Depot is increasing the dividend per share year over year in the last 10 years. And if we look again, we can see that right now they're paying out $7.60 per share, giving us a payout ratio right now of 44.32%. Now looking at the dividend summary, I'm feeling pretty comfortable with what I see. We've got 13 years of dividend growth, a 5-year dividend growth rate, which is phenomenal at 16.38%, and a payout ratio, again, it's only 45.81%, which makes me think that they've got some ability to continue to pay out that dividend. Now, I'm not by any means suggesting that you go out and add shares of Home Depot to your portfolio. Always take this with a grain of salt, but just kind of taking you all through my process for what I'm looking at when I decide. And this really all makes me pretty comfortable. But what I also want to look at is what is the total return from Home Depot. We can see that Home Depot is doing just as well as the rest of the S&P 500. And in the last 3 years, Home Depot's doing pretty good. They're doubling that return of the S&P 500. In the last 5 years, we see a 91% return. In the last 10 years, we see a 558% return on Home Depot. And it's that kind of history and longevity that kind of led me to Home Depot, along with the fact that I kind of love Home Depot, you guys. I'm a fan. I shop there pretty often. We are DIYers around here doing our best to save as much money as we can so that we can invest more. Now let's dig into the other warning that we got, and it's Algonquin. And yes, I must admit, I've got a pit in my stomach over Algonquin right now, but let's see what Seeking Alpha has to say and why this is popping up as a warning sign. Frankly, from a share price perspective, they are presently performing badly. It's pretty rough. So let's take a peek at that and see what else is under the hood of Algonquin. Right now, you can see that they're trading for $6.73 a share, which when you look at the 52-week range, the high was $16.01. So in the last year, we've got a 52% drop in share price. The dividend yield is 10.78%, which again, when you see a high yield like that, you need to think, okay, is this actually sustainable? So let's look at the financials of Algonquin Power and Utilities. Looking at the income statement for Algonquin, you can see that they have continued to grow their total revenues year over year. They did have a dip down in December of 2019, but since that and in the trailing 12 months, they have continued to grow their revenues. And here's the red flag moment for me, the basic earnings per share. You can see things were pretty flat in December 14, 15, 16, 17. We had an increase in earnings per share going into 18, 2019, 2020, and then the bottom kind of fell out in 2021. And if we follow this across, you can see here's 2021, the earnings per share were only 41 cents. And now in the trailing 12 months, we're down to 4 cents a share. Are we concerned? Yeah, that does concern me, because when I look at the dividend per share, which right now has continued to grow, while this looks fantastic, right? We've continued to grow year over year. Is this sustainable? If we're paying shareholders 70 cents for each share that they own, yet we're only earning 4 cents for each share that we own, where are we getting the money to continue to pay that dividend? So this is concerning to me. As a shareholder of Algonquin, what am I going to do with this? And if any of my fellow dividend investors have any wisdom to impart, I am so happy to hear it. So please leave me a comment below and let me know what you would do if you were in my shoes, because I probably have about 150 shares of Algonquin. Now, again, is it worth much right now? No, because it's trading for $6.73, but I still have to make a decision about what I'm going to do with my holdings in this company. So I would love some friendly advice if y'all have it to offer. Let's take a peek at those dividends. And here we can see we've got that safety score of a C, dividend growth is a D, A+ in yield, yeah, yay yield, but they can't really sustain it based on that payout ratio, and a B in dividend consistency. So we've got 9 years of dividend growth, the 5-year dividend growth rate at 9.07%, and here's the concerning part, right? The payout ratio is 101.86, not really feeling so sustainable right now. So what would you do if you were in my shoes? If you have shares of Home Depot, are you buying, are you holding, or are you selling? And if you have shares of Algonquin, same question, buy, sell, or hold. What would you guys do? Now take a peek at this video next.